Okay, what is up, tycoons? What's up, traders? Super excited for today's video. We got another TLT and market update. And guys, you're gonna really enjoy this one. Okay, I'm putting charts out there that nobody else is really showing you guys, and some really good info. One of the main reasons that we've been covering TLT on this channel because it's been a leading indicator for the stock market as well. So I'm going to go over that in this video, as well as a bunch of other crucial data and charts. So make sure to smash that like button, subscribe to the channel, and share the video so other people can find the channel as well. Now, what we're looking here is the S&P 500 futures in red, and we have TLT in orange. And the reason I say it's a leading indicator is because anytime there's been a divergence between the S&P 500 and TLT, the stock market has followed the divergence, and essentially what TLT is doing. So if you see here, we're making higher highs on the S&P, we're making lower highs on TLT, right? And eventually after that, you see the S&P 500 follows TLT and goes in a downtrend, right? And same thing happens over here. TLT is making lower highs, S&P 500 is making higher highs, and then we see a sharp pullback afterwards, and it follows what TLT is doing. Now, it also works to the opposite direction as well. We have higher lows on TLT, but we have lower lows on the S&P 500, and then the S&P follows TLT, and we see a nice move to the upside, right? And then back over here, higher highs, lower highs, S&P follows. And I mentioned this many times as the stock market was rallying. In my TLT videos, I said we need to be cautious, because if this pattern is going to play out again, where essentially the S&P 500 follows TLT, we were making lower highs and in a downtrend on TLT, while the S&P 500 was making higher highs, and we did end up getting a sharp pullback. We have gotten that sharp pullback since then. And if you've been watching these videos, then maybe you weren't so surprised by this pullback, and maybe you're ready or even able to capitalize off of this. Now, the TLT chart is as textbook as it gets, guys. Whether you're bullish or bearish, it presents you really good opportunities for trading, especially if you trade options. So let's go over the first bearish scenario that we initially had. I'll go over the different indicators that I use to really help me out. But if you take a look here, right, we have a little bit of a double top, right? So we have a high here and a high here. That's one signal, okay? And then number two, we get the rising wedge right here. So we get a rising wedge plus a double top. Okay, and this is how a rising wedge works. It's a reversal pattern, and you'll see a sharp move to the downside. And we definitely got that sharp move to the downside. We got the double top to play out as well with the sharp move to the downside. And if you look at your MACD, okay, now this is the daily time frame. This little screenshot that we're looking at of TLT. The MACD has been very useful on the daily chart for entry and exit signals, right? So over here, we can see that the red line crossed below the blue line here on the MACD. That would be an exit signal, right? And so we can see that we, after we got that exit signal, we had a sharp move to the downside, finishing off our wave one. And then we ended up putting a double, well, initially, okay, back to this bearish move. Not only did we have a MACD exit signal right here, okay, where the red line crossed below the blue line, but we also had bearish divergence. Okay, so if you're not familiar with that, essentially that's where the stock price would be going up, but the relative strength index is going down. So if you see here, we actually have a bearish channel while we have a rising wedge right here. So the stock price is going up of TLT, but the relative strength index is making lower highs and lower lows. That would be a term known as bearish divergence. So we really had about four different signals to look for on the daily time frame that TLT was going to get a sharp move down. And then afterwards, we ended up getting many signals saying that TLT was going to start a rally, right? We had the abandoned baby chart pattern, which that's what this is right here. And you can see we have the candlestick on the left, and then you get the abandoned baby right here. This is the abandoned baby, and then it's followed by a nice move to the upside and a bullish trend reversal. And you can see since that moment, we've had a very good bullish reversal. We're able to get about 80% in the Discord off of this abandoned baby setup. But not only did it have the abandoned baby, we also had bullish divergence, the opposite of bearish. So we had a low here and we had a lower low right here. And then on our RSI, we actually had a low, and then we had a higher low as well. So multiple things aligning together. We had the abandoned baby, we had the double bottom, okay, and we had bullish divergence. So 3 signals for a possible entry. If you take a look at the MACD right now, it's starting to curl back up above this blue line. And in my last video, I showed you guys that there was many divergences on the treasury yields. And so remember, as treasury yields go up, you're going to see bond prices go down. And if the bearish divergence plays out on the treasury yields, you're going to see treasury yields go down, and then you're going to see the prices of bonds and TLT start to go back up. So it's going to be really interesting. Is this a false signal here on the MACD as it's starting to cross above the blue line right here? Or is this possibly about to start another rally in TLT and push things back up higher? We'll just have to wait and see. What's really interesting to me, which doesn't give me full confidence in this MACD crossover right here, is we're retesting the trend line on our relative strength index that we broke below, right? So we can see, we ended up breaking below this point instead of acting as support, and then we flipped it to resistance and continued to head lower. Remember, this is the initial bearish divergence that helped the move down end up happening, right? And so we broke through that level and we're come back and retested it again. And then we're retesting it again right now. So the more times you test the trend line, the weaker it gets. But it's been a pretty strong trend line that we've been rejecting. So we definitely need to be cautious here if you're trying to go long, and look to see if we're going to be able to break through this divergence trend line and continue this uptrend. 102.88 is still a really big resistance level that we need to get above when it comes to TLT. But yeah, I mean, it doesn't get more textbook than that, guys. You had the bullish trade had about 3 bullish indicators and ended up playing out. The bearish trade had about 4 technical indicators, ended up playing out. So TLT is pretty textbook, guys. It's about as textbook as it gets. Now, if you guys are wondering and you ever want to get my real-time market updates on TLT, on the rest of the stock market, what individual stocks we're looking at, then you can join the Discord, okay, the Options Trading Tycoons Discord. There's a link in the description. Use code Zackley, like the channel name Zackley Trades. And essentially what we're looking at here is this is yesterday's price action, okay, 9:41 in the morning. I'm taking a screenshot of my chart and saying, hey, TLT is putting in a double top here, right? This could be a good put entry right here. And then you can see that later on in the day, around 123, we can see that we did get that reversal. We closed below the 102.67 resistance level, bullish price target on TLT on the 1-hour chart. Even though we were above over here, that double top got put in and we saw a big reversal, okay? We had some traders able to get over 100% on options, right? On put options, basically options going short on TLT, and really good trading opportunities in the Discord. Okay, now this is the bearish 5-wave structure that we've been tracking on TLT in orange, okay, and this is since March of 2021, or I'm sorry, March of 2022, which is right around when the Fed actually started doing their rate hikes, right? So this is a bearish 5-wave structure based on the rate hike cycle, and we can in wave 1, okay, so A, C, and E, these should be 5-wave impulsive moves, and then your wave B right here and your wave D, wave 2 and 4 should be ABC corrections, right? And so you can see here we got a 1, 2, 3, 4, 5 down. All right, that completed our A wave, our wave 1 of the larger 5-wave structure. Then we got an ABC correction up. Okay, we topped out at our 50% retracement level. And the reason we use these 3 retracement levels, the 61.8, the 50%, and the 38.2, is they help you establish trend continuation versus trend reversals, because nothing moves in a straight line down or in a straight line up. Rather, you get a move down retracement, continuation of the trend, okay? And we've been in a bearish cycle. So, that's what we're looking at, right? Even here, we move down, we retrace up to the 38.2% retracement level, and then continue that trend, make lower lows. So it's going to be really interesting to see how the rest of it plays out. Our wave C, our wave 3 was a very nice 1, 2, 3, 4, 5 as well. And then followed by the ABC correction. We topped out here at our 61.8% level, which is right around 109.69. And then, we see that we get the chart patterns that I just showed you guys earlier. We ended up putting in that double top. Okay, here recently we put in a double bottom. So the structure isn't necessarily following the clean 5-wave structure to the downside anymore. But that doesn't mean that there hasn't been trading opportunities, right? That's what the last couple slides were there to show you guys, is that, even though the structure hasn't been cleanest on this 1, 2, 3, 4, 5 down, as of here recently, due to the consolidation, we're going to see if it can still ultimately play out. And if it does, it would bring things down to about 87.29 potentially even to about 81.14. So I'm really interested to see what's going to happen in that area. We have these blue boxes here. These are what's known as gaps on the daily chart. And so we have about 2 gaps down now to fill on TLT. So it's going to be really interesting to see, do we end up filling those gaps down, or do we fill up those gaps to the upside first, right? We have a gap up right here and another gap up right here. So that's something that I'm paying attention to closely when it comes to the macro. Right, in the overall picture, I'm still tracking this 5-way pattern to the downside, but just like we use the Fibonacci's, okay, to spot trend continuation, you can also use it to spot trend reversals. So a reversal would look like this: a move down, a retracement, and then consolidation, and ultimately a breakthrough of those retracement levels. So if you take a look, we've had this move down, and then we're retracing through this area and consolidating. So the more time we spend in consolidation, the higher chance that we have the ability to really break through those levels and ultimately invalidate this last wave 5 right here, the wave E. So it's going to be real interesting to see how it plays out. But until we really break that structure and break through these levels up here, ultimately I'm still going to be tracking the move down towards the downside. Now, we're looking for a pretty big move down on TLT, but when it comes to the stock market, there's lots of bearish patterns, right? So this is the S&P 500, the SPX chart, right? And we have what's known as a bump and run, right? So, here's your initial lead-in angle, and then you have the bump angle, and you can see we broke this trend line here. And essentially this is the bump and run pattern right here, okay? So, you extend your trend line out, and once you break through this trend line, most likely you would expect it to come back and retest some of the previous lows, right? So this could send the S&P 500 back to the 3,600 region if this pattern ends up playing out. But this isn't the only bearish pattern we have. Look at this as well. This is the SPX weekly chart, okay, and it's following the Wyckoff method right now. So the Wyckoff is over here to the right, and then we have the SPX weekly chart. We can see that we have all the phases so far. We have spring, and then we have distribution. Take a look at spring, take a look at distribution. Almost looks identical to the chart here. Then we get the breakdown, right? And we have the breakdown here as well. And then you get the move down off of the breakdown and the throwback back above that initial trend line. You can see we have the throwback here, and then we head into this correction phase, right? And so that's exactly where we're at right now. We're in the correction phase. And I was warning a lot of people when we were up here, hey, if we're in this correction phase, we could be due for a really big move down into redistribution. And, we can see that, since we were up near that 4,200 region, we've actually gotten a pretty significant pullback of about, 200 or 300 points when it comes to the SPX. Now, we don't have to head into redistribution, okay? So I'm not saying for sure that the S&P is going to go down to 34 to 3,000. Okay, this could actually turn into accumulation rather than the correction phase. That's definitely very possible. So, I just want to more tell people to keep an open mindset, right? And just be prepared for some of these scenarios and don't let them catch you by surprise. The third bearish setup that we have on the S&P 500 is going to be a head and shoulders pattern, right? And so this is the daily time frame again. And you can see we have the left shoulder, we have a head put in, and if we consolidate in here range bound for a little bit, or even come back up to the 4120 area, okay, that's going to ultimately put in our right shoulder. And if we aren't able to really break out past there and retest the highs, the previous highs, or break out past those previous highs, ultimately we're going to end up putting a head and shoulders. And that's another chart pattern that could take us back down to retest some of the previous lows, anywhere from like the 3,500 to 3,600 region when it comes to SPX. Now, can the S&P 500 CAPE ratio help predict a market crash? The S&P 500 Shiller CAPE ratio has a strong track record of predicting market declines. Out of 21 major market declines since 1950, the CAPE ratio has provided warnings for 10 of them by breaching its long-term average. The chart below shows that relative peaks in the CAPE ratio coincide with drawdowns for the S&P 500. Knowing the ratio is directly affected by declining equity prices, the question becomes, are we seeing a relative peak in valuations to start 2023? And so if that was a little confusing for you, I'll explain it on the chart right here. Okay, so this is the S&P 500 Shiller CAPE ratio, and then this is the percentage levels off the high, aka the drawdowns essentially. And so what you're seeing here is this is the average, the 27.63. all right, over the past few years. And so you can see, once we come up and we put in a high over here, and then very shortly afterwards, the S&P 500 had a big drawdown. Okay. And then over here, you see we do get some type of little bit of bounce around the Shiller ratio, but we're above the average, and we get that bounce and we're still above the average. So it means we have a move down to make, right? And we get a big move down. And then over here, we retest that level, right? The 2763 level. And you can see that that's followed by a really big move to the downside as well. Over here, we're back up above all in these ranges, and you can see there's a series of big drawdowns throughout this time period. Each time that the CAPE ratio essentially is up above this average here of 2763. Now, something else we have on the chart here is the 10-year 3-month Treasury yield curve, and we also have the 10-year 2-year Treasury yield curve. And you can see that both of these are pretty inverted right now. The 10-year 3-month is like the most inverted it's ever been. And, the really scary part is that typically you don't see a recession until after the yield curve uninverts, right? So we see it's inverted right here. And then these shaded areas, these are actually recessions. So you see, once it's actually uninverted, that's when we ultimately end up getting a recession in the market, right? Over here, we see, the yield curve inverted. After it uninverts, that's when we see a recession. Over here, inverted, uninverts, that's when we see a recession. And it's something very similar on the 10-year, 2-year, right? Inverted, uninverts, and then we get the recession. Inverted, uninverts, then we get the recession. Inverted, uninverts, then we get the recession. And so, we could be due for a recession, and maybe not even this year, but actually in 2024. That's something that a lot of people really aren't thinking of. The big talk right now is 2023 is we're going to get soft landing or even no landing due to the job market being so strong, due to prices keep going up and things like that. But all of this strong economy data is really just going to push the Fed to keep the rates higher for longer. Now, the S&P 500 Shiller CAPE ratio is also known as the cyclically adjusted price to earnings ratio. It measures the S&P 500's current price compared to the 10-year moving average of companies' inflation adjusted earnings. Invented by economist Robert Shiller, the metric is also popular for understanding long-term stock market valuations. A higher CAPE ratio could signal lower returns in the future, whereas a lower CAPE ratio could signal higher returns as the ratio reverts back to its mean. The stock market is not the economy, but worries of a recession have been weighing heavily on investors' minds. So what is the CAPE ratio saying after the S&P's hot start in 2023? We can see here. All right, and essentially we're going to go over that. So this is this is it zoomed in here over the past few years, and then this is a broader picture back from the 60s and 50s. But the CAPE ratio reached a relative peak of 30.99 just before the pandemic sell-off, then climbed to 38.58, its second highest value ever, near the end of 2021. With stocks rallying to start 2023, the CAPE has climbed to around 30.38, meaning prices for stocks in the S&P 500 are nearly par with their February 2020 levels. And so this is, the end of 2021 right here. And you can see, what we talked about in the last slide is that the higher the CAPE ratio, the more likelihood that stocks are going to have a sell-off, right? And so the S&P 500 is actually in orange right here. And, ultimately it did get that really, really sharp move after such a high peak in the CAPE ratio. Now, this is the pre-pandemic peak right here at 30.99, and we're extremely close to that, guys. And, this means that the S&P 500 could be due back down for another leg down as, we're pretty much starting the year off with a really, really high CAPE ratio that's got a few people worried. Now, a longer term looks back shows the degree to which valuations has risen over the years. All right, and you can see that this thing is far above its historical average. That's something that basically I'm paying attention to right here. Is we see the average is 20.12, and we can see that the CAPE ratio is up here at 30.38. Pretty high, guys, pretty high. Especially compared to historical. We're up here above the like mid 2000s, right? And so this is like the 08 financial crisis right in through this time period. And we're above those levels right there. You can take a look at the dot-com bubble. We were all the way up at 44.20, absolutely crazy. And, that's right around 2000. And you can see it predicted that market crash. Same thing over here, really elevated levels. And then we got a big move down. and we're still really elevated when it comes to the S&P 500 and the CAPE ratio. So just something else that I wanted to show you guys to be aware of. Now, Jerome Powell is now hinting towards a 50 basis point rate hike at the next meeting. On the other hand, the Bank of Canada has already paused rate hikes. And so if you're not familiar, you can actually use the CME tool, and you can track the basically the projections at what they're predicting the next Fed fund rate is going to be, and what the next rate hike is going to be. And now they're at about an 80% chance that Jerome Powell is about to do a 50 basis point rate hike for the March 22nd, 2023 meeting. So if this continues to stay really high at 80%, or even continues to go higher, and Jerome Powell ends up only doing 25 basis points, most likely we're going to see a really big rally in the market. And if he does the 50 basis points, it seems to me that the market is already trying to price that in. So we may not see as much as a huge reaction as people think to the downside if they're already starting to price in a 50 basis point rate hike. Now, why is he doing that, right? Why is he going up to 50%? What's some of the data that he's looking at? Well, this is the inflation expectations, okay? And you can see that the downtrend here is clearly broken, guys. The downtrend has been broken, and inflation expectations have really been skyrocketing. This is something definitely that the Fed is paying attention to. If you take a look here, we currently are higher than the summer of 2022, right? So this is the summer of 2022, and you can see we're actually above those levels when it comes to the inflation expectations. Now, why is that important? Well, what we're looking at here is the stock market versus financial conditions chart. This is the summer of 2022, and look at what we were at. We were at highs in the stock market, and then ultimately we ended up crashing down. Now, we also have financial conditions on this chart. We have the adjusted national financial conditions index in yellow, and we have the regular national financial conditions index in white. And so you can see that financial conditions really hit this bottom here temporarily right before Jackson Hole speech in the summer of 2022. And then ultimately, Jerome Powell gave his famous Jackson Hole speech and really crashed the market. And we saw financial conditions just skyrocket back up. Well, since then, we've increased the Fed fund rate by about 300 basis points. And look, guys, financial conditions are looser, right? And the stock market has been rallying as a result. Now, we have started to see them tick back up a little bit. And, you're starting to see the S&P go back down a little bit as well. So this is, just something worth mentioning, why I mentioned that, hey, we're up here at the above summer, inflation expectations. And this is when Jerome Powell gave his Jackson Hole speech. So we're going to see, is he going to come off more bearish and more hawkish because of this, during his next FOMC meeting? And maybe that's why a lot of people are pricing in a 50 basis point rate hike. Now, this is core sticky inflation versus the Fed funds rate. And this chart really does a great job of just visualizing how sticky inflation is going to be, that it's definitely not just going to U-turn and come down soon. It's going to be pretty sticky, right? So we have the Fed funds rate in red here, and then we have the core sticky inflation in blue. And we can see that, once the Fed fund rate actually gets up above core sticky inflation, that's when we start to see a decline down, right? It gets up above here, and then we start to see a decline down. It gets up above here, and then that's when we see a decline down in core sticky inflation. And that's ultimately really, it just shows that they still have some more rate hikes to do, which is the whole premise of, higher rates for longer, right? We see the Fed fund rate gets up above, and then core sticky inflation drops, and core sticky inflation has just gone straight up pretty much. It's starting to consolidate. It did put in a temporary peak, but, the whole premise behind this is that it may just, consolidate rather than just going back straight down. The next chart we're going to look at here, well, it's not even a chart, but we are getting a little bit of confusing signals in the market, right? Because Bostic here recently just said the Fed might be able to suspend additional rate increases by mid-year sooner than some expect. And so stocks advanced following those dovish comments. But then, now we're getting people pricing in, and the Fed funds futures market is pricing in 50 basis points on the next rate hike. And so any fear that we may face two-sided risk in achieving our dual mandate was blown away by the January employment numbers. and a lot of the January data came in really hot, and really strong, and suggesting a strong economy. And that's not what necessarily we want to see as investors, because the Fed ultimately controls the market when it comes to the stock market. And the stronger the economy looks, then the easier it's going to be for him to keep hiking rates until we start to see it weakening. Last month, we received a barrage of data that has challenged the view in January that the FOMC was making significant progress in moderating economic activity and reducing inflation. And a lot of people's outlook has shifted since the end of January. Financial market participants have revised their outlooks in a way that has led them to mark up their expectations for the federal fund rates at the end of 2023. And we have a little bit here talking about the labor strikes across Europe affecting inflation. Service price inflation, as opposed to inflation in the cost of goods, is often driven by an increase in wages, with record number of strikes and other activities by organized labor in Europe, particularly in France. The annual rate of change for negotiated wage rates almost doubled in 2022. This has led some to warn of the risk of a wage price spiral, where consumer prices rise in response to high wages, creating further inflation, although some analysts dismiss the prospect as unlikely. With unemployment rate in the Eurozone at 6.7%, just a touch higher than October's record low of 6.6, workers are seemingly in a strong bargaining position. The labor market remained exceptionally tight, adding that the central bank expected price pressures acting on labor-intensive services unlikely to stop anytime soon. And so here, we have this article, and what they're saying essentially is to look at the data, over a 4-month annualized change, right? And so you can see here that this is the September 22 through January 23 annualized nominal PCE, retail sales, and real PCE. And so the nominal PCE is at about a 6.8% here, right? Here, nominal PCE rose by 6.8% annualized, resulting in a real PCE rising by 2.5% annualized. This would be a fairly solid rate, though slightly below overall PCE for 2022 as a whole, which came in at 2.8% on an annual basis. And so, to be clear, they're not trying to say that January data was bad by any means. It was very strong, but if you look through a different lens, right, it points to a more resilient economy than they expected in early 2023. However, they are more skeptical that the economy has seen a substantial renewed acceleration that will be sustained moving forward, and continue to expect a slowdown later in February 2023 once we move past the noise around the turn of the year. So, with that being said, the February data should provide further indication as to whether or not our early hypothesis was correct, and they were kind of essentially bullish. So we will be watching February releases carefully over the coming weeks. And we have those coming out here very, very soon. Those February reports, all of the inflation data, those are going to be coming out very, very soon. So it's definitely going to be a big market catalyst. If those things come in hot, then there's a very good chance that Jerome Powell is going to do the 50 basis points. And if they come in cold, then what we could see was that maybe January was just an exception, and maybe it was just something seasonal, right? A seasonal spike in January for some of the job numbers, for some of the inflation numbers, and rather that things are going to go back to cooling off in February. So we'll see what happens. Stay tuned for that for sure. Put your seatbelt on, because it's been a bumpy ride throughout the month of March, and it's going to continue to be a very volatile market. But this gives you guys really good trading opportunities. Okay, when the market is flat, that's really not much of a trader's environment. So embrace the volatility, look for the good setups, and stay safe out there. Okay, smash the like button, subscribe to the channel. I'm out.